Goodwill, nature and valuation. Meaning of goodwill. Goodwill is an intangible asset and an important aspect for an enterprise. It is something which places an enterprise at an advantageous position due to which the enterprise is able to earn higher profits without putting in extra efforts. It is so because the efforts have already been made in the past which have now the enterprise in an advantageous position. Goodwill is the present value of expected future income in excess of a normal return on the investment in tangible assets or for the excess of price paid for a business as a whole over the book value or over the computed or agreed value of all tangible new assets purchased. For example, if the enterprise has rendered good service to its customers, the customers will be satisfied from the quality of service, which in all likelihood will bring them back to the enterprise. In turn, the enterprise will achieve higher sales and thus higher profits. Definition: Goodwill. According to Lord Eldon, goodwill is nothing more than the probability that the old customers will resort to the old place. According to Lord MacNaughton, goodwill is a thing very easy to describe, very difficult to define. It is the benefit and advantage of the good name, reputation, and connections of a business. It is the attractive force which brings in customers. It is one thing which distinguishes an old established business from a new business at its first start. Characteristics of goodwill. The characteristics of goodwill are as follows. 1. It is an intangible asset, i.e., an asset which cannot be seen or touched. 2. It cannot have an existence separate from that of an enterprise. 3. Its value depends on the subjective judgment of the valued. 4. It helps to earn higher profits. It is the capitalized value of super profits. 5. It is an attractive force which brings in customers to old place of business. 6. It comes into existence due to various factors which as locational advantages, favorable contracts, location and market reputation. Key terms used in this chapter. Goodwill. Goodwill is the value of good name or reputation enjoyed by a firm that enables it to earn profit over and above the normal profits. It is an intangible asset. Purchased goodwill. Purchase goodwill means goodwill for which consideration has been paid. Self-generated goodwill. Self-generated goodwill is the goodwill that has been generated by the business because of which it is able to earn higher profit. Methods of valuation of goodwill. Simple average profit method. It is calculated by taking the average profit for a specified number of years and multiplying it with the years of purchase. Goodwill average profit x no of years purchase. Weighted average profit method. It is calculated by multiplying the profit for each year with the weight assigned to it. The amounts so arrived at are totaled and divided by the total of weights. The weighted average profit is multiplied by the years of purchase. Goodwill is equal to weighted average profit x no of years purchased. Super profit method. Super profit is the profit earned by the business that is in excess of the normal profit. Goodwill is determined by multiplying the super profit by the no of years purchased. Goodwill is equal to super profit x no of years purchased. Capitalization method. Capitalization of average profit. Under capitalization method, capitalization value of the business is determined by capitalizing the average profit by the normal rate of return. Out of the value so determined, value of net assets is deducted. The balance amount is the value of goodwill. Goodwill is equal to capitalized value net assets. Capitalization of super profit. Under this method, super profit is capitalized at the normal rate of return. Goodwill is equal to super profit x 100. Nature of goodwill. Goodwill is an intangible asset. Intangible asset means an asset not having physical existence. But it is not a fictitious asset. It can be sold, though a sale will be possible only along with the sale of the business itself. Sometimes, goodwill has more value than the tangible assets. Need for valuing goodwill. The need for valuation of goodwill arises in the following circumstances. 1. When there is a change in the profit-sharing ratio. 2. When a new partner is admitted. 3. When a partner retires or dies. 4. When partnership firm is sold as a going concern. 5. When two firms amalgamate. Factors affecting the value of goodwill. The goodwill of a firm is affected by all the factors which increase the earning capacity of the firm. These factors are 1. Efficient management. 2. Location. 3. Favorable contracts. 4. Advantage of patents. 5. Access to supplies. 6. Quality. 7. Market situation. 8. Nature of business. 9. Other factors. 1. Efficient management. If the management is capable and competent, the firm will earn high profits which will increase the value of goodwill. 2. Location. If the business is located at a favorable place, resulting in good sales or in economies, the value of goodwill will be correspondingly higher. 3. Favorable contracts. Sometime, a firm enters into long-term contracts for sale and purchase of goods at favorable prices. This will also affect profits and goodwill of the firm. 4. Advantage of patents. Normally, patents are necessary for the manufacture or production of certain types of articles. A firm which possesses the necessary patents will have a good value for its goodwill. 5. Access to supplies. When supplies of material are difficult to get, there will be a high value for goodwill for a firm which has good arrangements for getting supplies. 6. Quality. If a firm enjoys good reputation for the quality of its products, there will be a ready sale and the value of its goodwill, therefore, will be high. Seven. Market situation. If a firm is in a business wherein demand for the products dealt in is higher than the supply, it will lead to lower capital requirement and higher profit. It will thus increase the value of goodwill. 8. Nature of business. If the business of a firm is of the nature where the products dealt in are in high demand although not short in supply, the profit will be higher. It will, thus, increase the value of goodwill. 9. Other factors. A. After-sale service. B. Past performance of the enterprise. C. Good customers relations. And D. Good labor relations, etc. Classification of goodwill. Goodwill can be classified into two categories. I. Purchase goodwill and 2. Self-generated goodwill. 1. Purchase goodwill. It is the goodwill that is acquired by making a payment. For example, when a business is purchased, the excess of purchase consideration of its net assets, i.e., assets, liabilities, is the purchased goodwill. Features of purchased goodwill. I. It arises on the purchase of a business or purchase of a brand, etc. 2. Since the consideration is paid for it, it is recorded in the books of accounts. 3. It is shown in the balance sheet as an asset. 4. Value of goodwill is a subjective judgment, but it is ascertained when both purchaser and seller agree to its valuation. 2. Self-generated goodwill. It is an internally generated goodwill which arises from a number of factors, such as good location, efficient management, good quality of products, etc., that a running business possesses, due to which it is able to earn higher profit. Feature of self-generated goodwill. I. It is generated internally, generally over the years. 2. As 26, internally generated goodwill is not to be recognized as an asset, i.e., not to be recorded in the books of accounts. 3. Valuation depends on the subjective judgment of the valuer. Methods of valuation of goodwill. The methods for valuing goodwill are: 1. Average profit method. I. Simple average profit method. 2. Weighted average profit method. 2. Super profit method. 3. Capitalization method. I. Capitalization of average profit. 2. Capitalization of super profit. 1. Average profit method. Goodwill under average profit method can be calculated using simple average profit method or weighted average profit method. I. Simple average profit method. Under the simple average profit method, normal business profits earned by the business for the specified number of years are considered. Profits earned are totaled and average is determined. Average profit as calculated is multiplied by a number of years purchase to arrive at the value of goodwill. Number of years purchase means for how many years the firm will earn the same amount of profit because of its past efforts after change of ownership. This method is based on the assumption that a newly started business will not earn any profit during the initial years of its operation. Hence, one who purchases a running business pays goodwill for being in a position to earn profit in the initial years of business. Profit for valuation of goodwill means normal business profit of the firm. Thus, abnormal and non-business incomes are deducted from the profit for the year, while abnormal and non-business expenses or losses are added. They are not considered because goodwill is valued that of the business based on normal business profits. Profit for the year is adjusted for the errors and omissions of the past years of which profits are considered. Calculation of normal business profit. Normal business profit, also termed future maintainable profit, is determined for each year adjusting the year's profit for the following: I. Non-business gains, profits, and or losses. 2. Abnormal gains, profits, and losses. 3. Capital expenditure being accounted as revenue expense. 4. Revenue expense being accounted as capital expenditure. Revenue expense not having been accounted. 6. Errors committed in the past. This method is based on the assumption that profit of a newly started business will not be same as that of an established firm or enterprises during the initial years of its operation. Hence, person purchasing the business pays goodwill for being in a position to earn profit in the initial years of business. Calculation of normal business profit. Profit loss of past year before adjustment plus abnormal losses, loss by fire, loss by theft, plus loss on sale of fixed assets, plus overvaluation of opening stock, plus undervaluation of closing stock, plus non-recurring expenses, plus capital expenditure charged as revenue expenditure. Abnormal gains, gain on sale of fixed assets. Overvaluation of closing stock. Undervaluation of opening stock. Non-recurring incomes. Non-business income. Management cost, partners' remuneration. Any future expense, like insurance premium. Adjusted business profit, future maintainable profit, for the year. Goodwill under this method is calculated as follows. Calculate normal past business profits for each year by deducting abnormal gains and non-business incomes and adding abnormal losses and non-business expenses. 2. Add the profit calculated as per 1 above. 3. Calculate average profit as follows. Average profit is equal to 2. Note, above average profit is known as actual average profit or average maintainable profit in future. 4. Calculate goodwill applying the formula. Goodwill is equal to average profit as per 3x no of year's purchase. Weighted average profit method. Under the weighted average profit method, each year's profit is multiplied by the number of assigned weights, i.e., 1, 2, 3, 4, etc., and the value is ascertained. The products are added and divided by the total of weights to arrive at the average profit. The weighted average profit so arrived at are multiplied by the agreed number of years purchased to arrive at the value of goodwill. Weighted average profit is equal to goodwill is equal to weighted average profit x no of years purchase. It may be noted that more weightage is assigned to the recent profits because it represents profits for the latest year, and it is likely that in the following years same trend will continue. This method is considered better than the simple average profit method because it gives more weightage to the profits of recent years. This method is particularly effective when the profits show a rising or falling trend. 2. Super profit. Capital employed in a business yields a profit. Some of the enterprises earn more profit, while others earn less profit on the capital employed. When a similar type of business earns profit as a certain percentage of the capital employed, it is called normal return. But a buyer's advantage lies in the excess of the normal return on capital employed. It is only such enterprises which enjoy goodwill. The excess of actual profit over the normal profit is called super profit. Super profit meaning. Super profit is the excess of estimated future profit than the normal profit. It is a way of determining the extra profits that are earned by the business. The goodwill is determined by multiplying the value of super profits by a certain number, that number being the number of years of purchase. Goodwill under this method is calculated by multiplying the super profit with the agreed number of years purchase. Calculation of goodwill. Calculate average capital employed as is equal to a quarter dot plus dot to a half. OC opening capital employed, CC closing capital employed. Capital employed is equal to capital plus free reserves, fictitious assets, if any. Or all assets other than goodwill, fictitious assets and non-trade investments, outsiders' liabilities. I. Calculate actual expected profit, i.e., actual average profit. 2. Calculate normal profit on average capital employed by applying the following formula. Average capital employed x 100. Note, normal rate or return refers to the rate of return normally earned by other firms in the same industry. 4. Calculate super profit, i.e., Actual average profit, normal profit. We calculate value of goodwill as follows. Goodwill is equal to super profit, no of year's purchase. Three. Capitalization method. Under the capitalization method, goodwill can be valued in two ways. I. Capitalization of average profit method or 2. Capitalization of super profit method. I. Capitalization of average profit method. Under this method, goodwill is calculated by deducting capital employed, i.e., net assets as on the date of valuation, in the business from the capitalized value of average profit on the basis of normal rate of return. Capitalized value of the business is ascertained by capitalizing profits earned at the normal rate of profit. It is calculated as follows. Is equal to average profit x 100, normal rate of return, profit. Net assets is equal to all assets, other than goodwill, fictitious assets and non-trade investments, at their current values minus outsiders' liabilities. Steps. Calculate average normal profit earned. Calculate capitalized value of the firm by using the above formula. 3. Determine the value of net assets on the date of valuation of goodwill. Net assets is equal to all assets, other than goodwill, fictitious assets and non-trade investments, at their current values minus outsiders' liabilities. 4. Goodwill is equal to capitalized value, net assets. Note: this method is useful when the actual profits are less than the normal profit. 2. Capitalization of super profit. Under this method, goodwill is calculated by capitalization of super profit. In other words, goodwill is ascertained by capitalizing the super profit on the basis on normal rate of return. For calculating the goodwill under this method, the steps are: 1. Calculate capital employed, i.e., net assets as on the date of valuation of the firm. 2. Calculate normal profit on capital employed by using the following formula. Normal profit is equal to capital employed times required rate of return 100. 3. Calculate average profit of past years, i.e., 3 to 5 years. 4. Calculate super profit, i.e., is equal to actual average profit, normal profit. 5. Goodwill is equal to super profit times 100. What is capital employed? Capital employed refers to the amount of capital investment a business uses to operate and provides an indication of how a company is investing its money. Although capital employed can be defined in different contexts, it generally refers to the capital utilized by the company to generate profits. The figure is commonly used in the return on capital employed (ROCE) ratio to measure a company's profitability and efficiency of capital use. Formula: capital employed is equal to total assets, current liabilities. Total assets are the total book value of all assets. Current liabilities, CL, are liabilities due within a year. Or, capital employed is equal to fixed assets plus working capital. Fixed assets, also known as capital assets, are assets that are purchased for long-term use and are vital to the operations of the company. Examples are property, plant and equipment, PP&E. Working capital is the capital available for daily operations and is calculated as current assets minus current liabilities. Nature and characteristics of goodwill. I. It is an intangible asset and not a fictitious asset. 2. It helps to earn more than normal profit. 3. It is an attractive force which brings in customers to the old place of business. 4. It is composed of a variety of elements. It is difficult to ascertain the exact value of goodwill. Factors affecting the value of goodwill. Value of goodwill depends upon the capacity of a business to earn profit in excess of normal profits. Therefore, all such factors which help to increase the profits of a business will also affect the value of goodwill. These factors are 1. Management, 2. Quality of products, 3. Favorable location, 4. Contracts, 5. Control over raw materials, and 6. Other factors like after sale. Classification of goodwill. Goodwill can be classified into two groups. 1. Purchase goodwill. Purchased goodwill means goodwill acquired by paying money or money's worth. It may be purchased as an intangible asset, but generally it arises when a firm is purchased by another firm and purchase price paid is in excess of the value of net assets, i.e., assets, liabilities, acquired. It is recorded in the books of account. 2. Self-generated goodwill. It is an internally generated goodwill which arises from a number or attributes that a running business possessed. It is not recorded in the books.